Look at that document I just sent you. Before we can wrap up, but I want to show you this. Basically, I pulled all IPOs since 2020. So this excludes all SPAC mergers and real estate, finance, material, energy, utility. So kind of the big, bulky private equity type stuff. So it's mostly tech, consumer. 627 IPOs since 2020. More than half of them, or basically half of them, are trading at 0.2 times the total cash they've burnt. So you can kind of look at total lifetime capital burnt by these companies in the retained earnings line on the balance sheet. And so when you pull out the retained earnings, it shows you how much money they've burnt over their lifetime. And so the total money burnt by half of these companies is about $107 billion. And the market cap of those companies is only $26 billion in aggregate. So a 0.2 times return on capital invested to date in terms of enterprise value divided by total capital invested in burnt to date.
Let me say it in English and you tell me if I said it right. So 627 non-SPAC, non-real estate, non-finance companies went public. So basically 627 tech companies went public since 2020. So 2 years.
Yep.
And of those 627 tech companies, almost half, or 300 of them, 48% of them, are today worth about 0.2 times all the money that went into them.
Yep.
My gosh. Wow.
Yep.
It's tough.
And then on the other half is the ones that have worked. So this kind of goes back to a power law point. But like as a venture industry, you think once you get a company public, it's successful. And the reality is that many of these companies from an economic perspective are still not successful. It looks like half, and perhaps much more if you include all the SPAC mergers, which is another couple hundred, and I would guess the vast majority of those meet this criteria, are trading at less than the total cash that's been invested in them.
Friedberg, this speaks to the age of excess that we just went through. We just weren't as efficient as we needed to be in running these companies, and now we're in the age of efficiency, austerity, excellence.
Totally. But it also
that's a great setup for a rebound, isn't it, Friedberg? Like I would be looking through these.
Look, I mean, one way to read this, I was speaking with someone who you can bleep him out. I was talking with 3 weeks ago, and he showed me in their, how much should I say here? This is a big investment firm, and they have a big growth portfolio. They have about 160 investments, 180 investments in their growth portfolio. 85% of the returns are generated by 10 companies of the 180. And that's in the growth portfolio. These are supposedly de-risked businesses.
The power law exists even in growth.
The power law exists in growth. And as you can see here, the power law exists quite dramatically post-IPO as well. Mm-hmm. So, as you can see here, only 9% of these businesses have generated positive earnings over time. 43%, about half of them, are worth more than the total cash that's been invested in them. And that multiple on cash...
This is a production board study here, by the way? This is done by your firm?
Yeah. It's off public data. So the multiple on the value of the companies that are worth more than the cash invested is 5.5 times. So in aggregate, IPOs since 2020 are worth 4.3 times the total cash that's been invested in them over their lifetime. But the crazy statistic is half of them are worth significantly less than the cash that's been invested in them, only 0.2 times. So the power law dominates both early growth and clearly being public. But I think to your point, Jay Cal, it also seriously speaks to the amount of excess, and it's really going to rationalize probably based on the conversations we had today about Twitter, Meta, Google,
Amazon,
and this as well. So certainly
the good news here is
change happening.
Friedberg, and correct me if I'm wrong here, Chamath, we want more companies to go public and have that discipline of being a public company. This was the big critique of this quiet era of companies taking 10, 12, 14 years to go public. This is going to be a strength for these entrepreneurs to have to fight it out in the public market under scrutiny. Correct, Chamath?
100%. I think like the Chris Hone letter, I think that there are a lot of VCs on boards of companies who would love to say the equivalent thing to their private
company. Yeah, for sure.
And part of the dynamics, as Friedberg just said, because it's such a power law and people believe that, you being with other VCs are really important. It turns out that most of these VCs abandon their role on these boards and don't really hold people accountable because they're worried it'll affect their deal flow. The problem is it's a negative reflexive loop. So these companies do poorly, and then as a result, they're viewed as not an effective board member, and so the next deal they get is a poorer and poorer quality. So the highly correlated portfolios in Silicon Valley are the ones that will get torched because most of those companies will receive very poor or no advice. And then the few that will get to the end is because they have hard-nosed people on the board that will force them to make really hard decisions.
Yeah.
That's it.
Sachs, any thoughts here on the public markets?
Wait, last thing. And by the way, Sequoia, who has had exceptional returns, has always been known to be hard-nosed. A lot of people, the critique against Sequoia from founders would be that, if I take Sequoia's money, they may fire me. Well, yeah, because if you're not good, it's the mission of the business is bigger than your ability to be the CEO. And so, you just have to remember, there is no free lunch. We were not giving out free money here.
The pendulum swung one direction too far. The tradition in Silicon Valley used to be you always replace the CEOs, the founders with a professional CEO, and Google being the turning point there, or maybe the last one. And then it became founders will control their companies with super voting shares forever. Hopefully the pendulum now swings to some equilibrium. Sachs, what are you seeing in private markets?
The jobs program for surplus elites is going away.
The jobs program.
That's the TLDR.
Surplus elites is just
surplus elites is going away.
Professional managerial class is under pressure.
Yes.
That's for sure.
If you went woke, you may go broke because you have no marketable skills.
Man, your punch-up guy is on fire. Is Dean giving you these one-liners?
Who's Dean? You got somebody in the room with you?
I have no punch-up guy.
Dean's helping you for sure.
I think he's got somebody handing him notes.
I'm punching myself up.
Who, Jackie the Joke Man Marling handing you little notes there? All right.